Good morning, ladies and gentlemen. My name is Mark Hilson. I am a trustee of the Romspen Mortgage Investment Fund and a director of Romspen Investment Corporation, the fund manager. I would like to welcome everyone this morning to our 2025 annual meeting and thank everyone for coming today. As a courtesy, could we ask everyone to please turn off their electronic devices? Before we get started, I'd like to take a few moments to introduce the other trustees. To my left is Wesley Reutman, who I'm sure most of you are familiar with. And down in the front row, we have Arthur Resnick and Shelley Espen. The format for the meeting today will be to first proceed with the formal part of the meeting, following which we will review the results of 2024, outline our first quarter 2025 performance, provide some insights into the future performance of the fund, and discuss current issues and opportunities. Following that, we'll take your questions. Before starting, I need to caveat what we'll discuss today with the obligatory safe harbor statement, which is on the screen in front of us to protect both you and the fund. I'll pause here for a few seconds. I would like to thank everyone who attended today in person or by proxy. I will make a brief presentation, following which Wes Reutman will review the fund's results for 2024 and its performance through the first quarter of 2025. Then Derek Jenkin will talk about some of the fund's new initiatives. Peter Olbaum will discuss the Romspen Development Group, and Brent Forrest, president of the Development Group, will highlight some of that group's work. After that, we will open the floor for all questions from unit holders. So just a quick overview of the fund. Romspen is one of the leading non-commercial mortgage lenders in the country. We have an AUM of just over $3 billion. And the performance over the last 20 years has been approximately 7% net to unit holders, which has outperformed most fixed income investments. Management and employees are one of the largest non-institutional investors in the fund with over $100 million invested. The mandate of the fund is relatively straightforward, is to deliver long-term attractive returns to unit holders that are uncorrelated with other investments such as the stock market, commodities, etc., with strict adherence to mortgage investment principles. And the track record, as I indicated earlier, was approximately 7% net to unit holders over the past 20 years, although, as everyone knows, our performance over the last 2 years has been somewhat difficult given the market conditions. Our approach to mortgage investing is really focused on risk mitigation and disciplined investment principles, guided by the following key metrics. First, primarily invested in first mortgages, which are safer. Also, being the size that we are and being able to see many opportunities in the marketplace gives us the opportunity to hopefully cherry pick the best opportunities to put into the fund. We tend to focus on more complicated mortgages because we tend to find that they have better returns overall. We try to structure them so there's significant downside protection, and we underwrite these mortgages on a loan-to-value ratio of approximately 65%. Interest rates that we charge are typically in the range of 10 to 12%, and we don't use structural leverage in the way the fund is managed, so that tries to mitigate the amplification aspects of having leverage in the fund. So with that overview, let me turn it over to Wes, and he will provide an overview of last year and first quarter 2025 performance.
So we changed the program a little bit this year to give a couple of our workout teammates an opportunity to introduce themselves to the investors and let everyone know that this is a company that's a lot bigger than Mark and I. I'm going to talk about our last year's performance. Just before I get started on that, I just want everyone to bear in mind that we are looking at and fighting our way through the toughest real estate market, especially for developers in at least 30 years in Canada. Perhaps the great financial crisis in the States was bad like this, but we weren't active in the U.S. at that time, and it's a very challenging market, and the results, are as a result of that. So, the 24 cents a unit's distributed. Almost all of that was reserved against. So there was a comment last year about why are we not using those reserves to reduce the taxable income. Well, the reason was the bank covenants prevented us from distributing any income, anything above taxable income. So we were restricted to taxable income distributions, and we couldn't use the write-off. So we had these historical write-offs. We convinced the banks when we redid the line to relieve us of that covenant, and so we used these write-offs, and we'll hopefully continue to use these write-offs so that at least we won't have to pay tax on these distributions while we're experiencing these write-downs. The portfolio mortgage rate went up slightly. It's due to a few increases on renewals. There has not been a lot of new loan activity. The mortgage portfolio is declining, both as a result of acquiring assets in foreclosures, selling off some of these assets, and as a result, you're seeing finally some realized losses. 68 million in 2024 of realized losses, the largest sum of realized losses we've had. Mind you, it still pales compared to the reserves. I think we reserved 150 or 160 million during the year. So we're still reserving more than we're realizing. But we did start realizing some losses in 2017, 17% in 2024. And our owned real estate, our REO, what we call REO, is climbing up now at 17% and probably headed a little bit higher before this is over. These bar charts show these numbers graphically. You can see the slight erosion in the investment portfolio over time. We showed a few more years of our leverage to see the use of the bank loan. After COVID, there was a bit of a post-COVID boom. We did a bunch of lending, leverage went up, and then interest rates, the inflation kicked in, interest rates went up, everything kind of turned around. We started deleveraging, and now we're right back to very little leverage. We have 2% net leverage is virtually nothing. And the net asset value continues to go down. That's a reflection of the reserving that I spoke of earlier. Our net earnings, this gives you the idea. The portfolio itself, even with the number of non-performing loans we have, would generate $150, $160 million of interest without reserves. There's some Forex impacts in here as well, but most of the decrease since 2022 has been due to reserves, appraisal, basically fair value adjustments. And so that's brought our income down to virtually nil. The distributions have followed. We still have enough liquidity to pay some distributions, so we'd like to do that for investors because we know many of you need some type of return, but we have to conserve cash because, as you see, we have a lot of workouts, and we need that money in order to enable a successful outcome with those workouts. The compound return has dropped accordingly. That's again a reflection of the reserving that's been taking place, and maybe we'll see what happens in the next years or so. But again, it's appraisers. It's up to appraisers. So we'll see what they say. The portfolio remains well diversified. The biggest category, of course, is mixed use, which is residential apartments usually or condos with ground floor retail, maybe some small office component, largely residential. The blue bar is also residential, usually single family or multifamily. Industrial, we have 18% of the fund in industrial assets. a little bit of retail, a little bit of hospitality and entertainment, and a bunch of odds and ends in different categories. So it's broadly diversified with a lot of concentration towards residential. By size of loan and size of investment, the largest chunk is, and this is probably why we are struggling with our liquidity as much as we are, is that we did a number of big loans. And these big loans happen to be the toughest to work out and work through, especially in times like this, because there are fewer buyers. The big giant developers are the ones who would work on those, and they're, for the most part, sitting on their hands because of the uncertainty. There's a lot, some sizable decreases lately in housing starts and land purchases, and new projects starting, which is really kind of where we focus, and that's been a tough go for us. The 60 to 80 category is another chunk of it. And in the smaller category of under 20, which is like kind of the bread and butter, or under 40, those you can actually move a few. And that's what's kept us going through this downturn. We've been able to liquefy a few of those smaller mortgages. They're a little easier. Not easy in this environment, but easier. By geography, we are a little more than half in the US now. Usually the big states would be the largest contribution down in the south: Texas, Florida, California. In Canada, biggest concentration, of course, Ontario and BC, with a little bit in Alberta. And the maturities are all very near term, and that's usually because we're just renewing short. There's not a lot of new lending, and so that won't go up until we get back to doing new loans. I put this chart in here because it's a long-term chart. Goes all the way back to, I guess, 1999, very beginning of the millennium, and it shows our returns, kind of looking at the long game. The yellow line is ROMSPEN. The jaggedy blue line up and down is the stock market, and the thick blue line is a bond index. And we've outperformed this basically almost every year. Outperformed these very broad market measures up until recently. And like I said at the beginning, I mean, this is a once in a 30-year type downturn. If we can get through this downturn with a few years of zero returns, I think I would call that a win. There's not a lot of investment funds that can span a 30-year cycle without some negative numbers. I mean, negative numbers are actually a thing in investing, and so if we can escape that, I think that's not too bad. In terms of loan performance, and this, I think, more than any, illustrates the challenges that we are facing. The performing loan book is down to 42%. The four biggest workouts are shown there along the top, which we've talked about for the last meeting anyway. And Brent will talk more about those as he gets up here. Loans that we've put on non-accrual status are up to 18%, and we're now at 16-17% of owned assets. So there's not a lot of the portfolio that's generating income for us. A lot of these bigger assets are complicated, as Mark mentioned. It takes time, effort. We need some help from the market. And so it's going to require some patience and hard work to fight through these. But they're all very interesting assets, and you'll see from the discussion when we get into that a little bit later. They have a lot of potential. The problem is the market today is not receptive to potential. So it's going to take time. It's going to take patience, but it will all be okay. So moving on to Q1, I don't think there's been any real change in tone. We're still seeing write-downs. We're still seeing low distributions and low liquidity, and effectively zero returns. Of course, that doesn't compare well with the indices at the moment because there's a lot of volatility in those indices, a lot of volatility in the world at the moment. And real estate is much more slow-moving and will adapt and change slowly. So we'll see how that goes. In terms of our outlook, the market is still very soft. By sector, I would say that if you want to look for some green shoots, the Bank of Canada interest rate decreases lately have helped in some of the smaller Canadian markets. In New Brunswick, for example, there is a little bit of life in that market. Alberta's doing okay. Montreal even is doing okay. The higher priced markets like Vancouver and Toronto are still struggling. I don't think rates have come down enough to make mortgage payments affordable in those markets yet. We'll probably need to see further interest rate reductions before you see some of that. In the States, it's also very patchy. They've not had mortgage rates decrease very much. I mean, they kind of want to, but then always something seems to happen that kicks them back up. So where you're seeing some activity is out of the Sun Belt. The Sun Belt has seen a lot of activity dry up. I think some of that's related to the tariffs and the general strain of and I know in South Florida, for example, the foreigners have stopped buying, and so that's slowing things down in certain markets where they have exposure to foreign buying. But it's been a challenging market in most of the U.S. In multifamily, even multifamily is struggling. We have a few multifamily assets, as some of you know, and it's much more challenging to keep them rented. You have to offer incentives now to keep tenants in there. You can't push the rents up like you could during COVID and the year or two after COVID. And construction costs have gone up. I mean, there's been a lot of construction through that period, a lot of new supply, but now it's becoming harder to build new apartments and have the economics of that work. And so, that kind of bodes well, I think, down the road. If we get some supply abatement, maybe the demand can catch up. But there's a lot of cross currents, right? Immigration is slowing. So, who knows where multifamily is going to go. In Canada, we have a program at the CMHC that's helping at least keep some construction going here. But it's becoming a tougher market. Retail, in experiential, like in the restaurants, the gyms, the climbing gyms, the various sectors where people actually have an experience in the store, there's some life. But traditional retail goods, it's terrible. You're probably aware of the Bay, and that's the end of a 350-year-old enterprise. It's going to take a lot of reimagining for some of that space. The prime stuff is still doing okay, but if you're off prime, it's tough. A lot of online purchasing, kind of decimating that whole sector. Office is still tough, very tough. I know that the Canadian banks are trying to bring people back. The government's trying to bring people back, but there's a lot of resistance. People are very used to the work at home and the work remote, and I don't know if office is ever going to be the same. So that's there's going to have to repurpose, I think, a lot of those buildings. The one we have two, I think, that are of note. The one up on Yonge Street at Yonge and Sheppard, which is, we're hoping, going to become a retirement home. It might be an institutional use instead of office. That's a rather good adaptive use for it. The other's in Houston, and I'm not sure what we're going to do with that. It could be residential. It's a little awkward location for residential, but that's in a bunch of litigation. We'll figure that out down the road. We fortunately don't have that much exposure to office. Industrial is still probably the best of the categories, although industrial itself is slowing, particularly with the trade uncertainty and tariffs. A lot of the larger industrial tenants are sitting on their hands waiting to see where trade policy goes and what their needs are going to be. But it's still doing better than, I think, the other sectors. And in leisure and entertainment, you've got hotels, I think, slowing. In fact, it was recently one of the noticeable upticks in the securitized loan defaults in hotels. So you're seeing some pressure now after that big boom that we had after COVID when everybody went traveling, and now with people, I guess, not traveling as much or not traveling to the U.S., you're starting to see some of a hit there. And so that's the outlook. I'm not sure when this is the biggest question we always get is, when is this going to turn? I don't know. I don't think anybody knows. I can tell you for sure it will turn. It always does. I mean, these are cycles, and you wait them through. But there's seems to be a lot of pressure on bringing interest rates down. I think that will help. There's a lag effect. So, once you start seeing the rates actually come down and mortgage rates come down, you might see within the next year or so a bit more life come back. But who knows when that's going to happen. With that, I'm going to pass it over to Derek, who's going to talk a bit about our new fund initiatives.
So this is our 19th AGM. And for decades, almost 2 decades, communication from the fund wasn't highly demanded. Our monthly fact sheets, our AGM, monthly statements, and that essentially was all that investors really required, because for a long time, this fund was very boring. It would return every month a very stable, steady return in all market conditions. So for years, that was really all that was required. The last few years, things have changed. And as a result, and one of the new fund initiatives is to increase fund communications. Now, many of you have attended my quarterly update calls. It's fairly well attended. I think over 500 attended the last call. In addition to that, we'll be looking to enhance our website. Our website will include new news briefs, announcements. So please stay tuned for enhancements to our website, which will include more regular communication about transactions, events, and other fund activities. In addition to that, outgoing activity, the last year, the fund committed to creating an advisory committee. This advisory committee is designed to essentially give our investors more of a behind-the-curtains access to the management company. So we are beginning with an advisory committee that will consist of 3 individuals. Martin Berger, who is the representative for Western University. Our view is that this member will represent essentially our institutional and family office investors. We have Scott Gibson, who's the president and CEO of EES Financial, also has a significant number of dollars invested across his client base with the fund. We feel he is a good fit for representing our retail investors. And then we have Stephen Jeffrey, who is a legacy lawyer who's worked with Romsman for a very long time, now retired. And this is a good opportunity for him to remain sort of in a position where he can help the fund going forward. The view here was to create this group with a well-balanced base so that those folks could opine on the various transactions, directions, strategies that the fund is looking to undertake, and be able to have a voice at the table representing the wider group of investors in the fund. And we're looking to have these meetings, aiming to do them on a quarterly basis, and also ad hoc, depending on sort of a material event that may come up. So those individuals, although only Scott is here today, they will have a more of an active voice within the fund going forward. And this is a part of our growing effort to increase communication, not only outbound from the manager to the investors, but also have the investors have more of a voice at the table on an ongoing basis. One of the main focuses of the fund, and I would say this is our primary focus, is to get the fund back on track. To get the fund back on track, we really have to be looking at two core initiatives. One is to increase returns. Many of you have shared your frustration with the low yield and slowly declining NAV of the fund. We hear you, and we know that this is an item that we need to address. And in a minute, I will talk about how we're going to go about doing that. The other item that we need to manage is redemptions. Many of you are looking to either, if we cannot get our yields up, would prefer to redeem from the fund. So the question is, what are we going to do to manage these two initiatives? Well, increasing returns really comes down to achieving four sort of topics or addressing four topics. One is, as a fund manager, we need to fulfill our obligations to our borrowers. So money coming back to the fund from either loans that are repaying us or owned assets that have been sold, that money coming back out, coming back to the fund, we first have to use that fund to make sure we're covering our basics. We have to make sure that we fulfill our obligations as the lender. Beyond that, we have, as Wes pointed out, a growing number of owned real estate projects in the fund. Many of these projects are mid-construction or early construction. Money has to be used to complete those projects, or at least get those projects to meaningful milestones where then they can be sold at full value. That typically takes money. And so some of the money coming back to the fund will be used to enhance those assets so that they can be sold, allowing money to come back into the fund, which leads me to the next topic, which is new mortgages. The only real way to get the yield up on a regular basis is to get back to our core business effort, which is to put money back into new mortgages. As Wes pointed or Mark pointed out, the typical range for our lending is 10 to 12%. And right now, a lot of our assets are not generating that return, which is what investors have been used to in receiving their monthly distributions. As we move more of our assets back from either owned real estates or loans that are not performing and move a higher percentage back into new mortgages that are performing at these higher rates, that will be reflected in a higher distribution for investors. And as I've shared with many of you here on my past calls or in one-on-one meetings, the true test of how we're doing will be in the distribution. The monthly distribution essentially acts as a monthly heartbeat of how we're performing. If the yields are zero, then obviously we're still having difficulties that we're looking to manage and resolve. As the yields start to increase, that versus anything I can tell you here today will be the true test that things are improving in the fund. And with that, the last item that we're looking to address this year, and it's becoming a sort of a front burner item, is resolve our runoff pool. Many investors who are looking to redeem elected to enter a runoff pool, which essentially puts you into a side class of unit where you would no longer participate in new loans or new fund initiatives. And as money was repaid to the fund, you would get your pro rata portion paid back to you, and your position would over time redeem down to zero. That initiative is something that we're looking to accelerate. Many of you in the runoff pool just received a redemption recently, and we're looking to continue that initiative going forward, and ideally looking to accelerate the runoff pool altogether. So for other investors looking to redeem, we'll be looking to manage redemptions through a secondary market transaction. This is an initiative where we will look to get new investors to come in to purchase the units from existing unit holders. This initiative is currently underway. We will look to have more information for you shortly. It is a 3-phase project. We're currently in phase 1, where phase 1 will wrap up probably by somewhere in July. Phase two, we're targeted to complete by the sort of in Q4, with the goal of being able to conduct our first secondary transaction if all things go to plan, which is difficult to guarantee. But our goal would be to try and have our first secondary transaction completed before the end of this year. The view here is that redemptions need to be managed through secondary transactions because in order to get our yields up, all capital coming back to the fund really needs to be used in a way that will help get the fund back on track. If we can use the money that's coming back to the fund to resolve the owned assets, to put more money back into performing loans, that increases the yield for all investors. To try and manage both redemptions and fund initiatives to get yield up at the same time, you will essentially achieve neither. And this fund will remain in a sort of a level of not being able to recover quickly and not be able to manage redemptions quickly. By putting money back into the fund, we will ideally get our liquidity levels back to normal levels more quickly. That will allow us to accelerate our recovery efforts and get back to normal fund operations as quickly as possible. Because the focus needs to be put all the recycled capital back into the fund, managing redemptions through secondary transactions essentially allows us to create a market where new investors coming into the fund will buy the units from existing unit holders, giving existing unit holders who are looking to redeem an opportunity to exit from their position and reclaim their capital. And as part of this initiative, Romspen knows we cannot do this on our own. We have partnered with a large reputable financial institution. More information on their involvement will be forthcoming in phase two. But we were looking to work with partners in order to facilitate this activity. And this will likely be the way we will manage redemption activity for the time being, until we can get the fund back to normal fund operations, of which a large part of that will be managing the real estate that we've had to foreclose and now own. And with that, and to talk about that topic, I'll now turn the table over to Peter Olbaum, who will discuss our owned real estate portfolio.
Throughout my time at Romspen, I've been largely focused on workouts. And over the last 2 years, in addition to my involvement in specific workout files, I've also been charged with expanding our workout group to handle the growing list of non-performing loans and owned assets brought on by the challenging economic conditions. Given the importance of our workout strategy to our business, we wanted to give you an idea as to the internal changes that Romspen intended to address this critical need. About 2 years ago, we introduced a new internal business unit called Romspen Development Group, which I refer to as RDG. Historically, workouts were managed under the broader Romspen umbrella, and most of the resources that were engaged in workouts for Romspen were also engaged in other aspects of our business. Unfortunately, as the list of owned assets and NPLs grew, the volume of work and the geographical diversification of that work outpaced our internal capacity. Our under-resourced workout group was forced to be overly reliant on external managers whose interests and incentives were not always perfectly aligned with our own, as hard as we would try. There was a clear need for us to evolve to a more robust, scalable, and specialized group. Our objectives in the reorganization were threefold. In the short term, most importantly, we're focused on efficiently and with greater accountability exiting our existing workouts. In the midterm, we're focused on greater efficiency and best practices in the development industry and building a scalable solution. And in the long term, we hope to utilize the expertise and skill sets we build to support our borrowers and to mitigate future NPLs. The guiding principles within RDG are critical to our success. They include aligning responsibilities with core competencies, broadening our core competencies with new specialized personnel, and reallocating projects within the group. We're centralizing and streamlining our project management. This includes a more hierarchical structure, which I will reveal in a few slides, with well-defined oversight and reporting obligations. We're applying lessons that we've learned to improve the future NPL outcomes. By working more as a unit and having more people engaged in each project, we're better able to have the benefit of our collective experience in our workouts. And we're modernizing our systems and workflows. We've recently invested heavily in industry standard software solutions to manage our development and asset management portfolio, and to provide enhanced reporting at all levels of the organization. The mandate is clear: to be accountable internally and externally, to work collaboratively to utilize our collective experience, to gain and utilize the increased specialization, to mitigate the key man risks associated with our historic structure, and most importantly, to accelerate our development and disposition of these assets. RDG's organizational structure is designed to allow us to build a scalable solution that is accountable and specialized. We're process-oriented. We're getting involved in our non-performing loans earlier. We're supporting our enforcement team with more diverse and specialized knowledge. We have greater dedicated resources that allow more efficient and complete management and decision-making in the projects. And of course, we are wholly accountable to the manager and the fund, and key decisions are always aligned with fund recovery as our sole mandate. To give you some idea of what these changes mean internally, we have grown from a small group of 3 or 4 managers that rely on non-dedicated resources to a team of around 15 people whose sole responsibilities are to RDG and helping us meet our goals and objectives. This organizational chart highlights the key individuals in RDG. However, RDG includes further resources within ROMSPEN in the legal, accounting, finance, and administration departments, who we rely on as well. I'd like to highlight a few of our most senior employees in RDG and briefly describe their experience. Richard Weldon is a managing partner and project asset manager. He has over 30 years of experience in real estate planning, construction, and leasing. He has built, owned, and managed hundreds of commercial and residential projects across North America. And prior to joining ROMSPEN in 2011, Richard was vice president at Sotheby's International Realty. Mark Aber, the head of asset management, has over 40 years in real estate investment, asset management, joint venture structuring, development, and construction. He has 15 years of practical experience in an advisory role to public and private real estate companies for workouts, and he has a master's degree in real estate development from Columbia University. David Stevenson, who came to us earlier this year as a construction and project manager, has 25 years of experience in architecture, urban planning, urban design, development, and construction. For 10 years, he was managing high-rise and mid-rise development in the GTA for 2 large GTA developers. He's a Bachelor of Urban Planning. He's a registered planner. He also has an architecture degree. Pierre Leonard, project manager, has 30 years of commercial real estate experience. He was a prior originator at ROMSPEN Investment Corporation, which is important because we are also scouring our ranks for talent that can be useful in RDG that is not actively involved or in new loans. He's also experienced in entitlements, planning, development, and construction, having successfully managed projects across North America. Bill Ulicki is a project manager. He previously managed acquisitions for an Ontario developer. He was a commercial broker for 10 years. He led the surplus asset disposition for Canadian National Railways in Ontario, which involved the re-entitlement and disposition of non-core lands. He has developed multiple residential projects. I would also like now to introduce Brent Forrest, who is the president of RDG. Brent arrived at ROMSPEN about 18 months ago. He's been instrumental in building out the RDG group, and alongside myself is responsible for its performance and execution in his role as president. Brent was previously the senior vice president of finance and acquisition for a large developer in North America. His deep understanding of project management, finance, debt markets, and best practices in the industry is critical to the growth and refinement of the ROMSPEN Development Group. With that, I would ask Brent to come up and discuss some of the larger projects we're working on, which will be instrumental in bringing liquidity back to our portfolio.
Thanks for the introduction, Pete. So many of the files I'm going to speak about today are still in active litigation, so I will have to be cautious on how much information I share. But the intent is to give a high-level overview of some of the advancements we've made over the past year. And although we call these workout files, in my view, some of them actually represent opportunities to leverage the experience of the team that Pete was just introduced. And I do believe that there's some opportunities for us in the short term to realize some positive return on the values. Given the challenges in the broader real estate market, which are impacting the majority of geographies and asset classes, in order to realize on the value of these assets, we need to take them from the state that they're in today when we take them over into something that's more marketable and easier to improve our disposition value. Quite often when we take over these assets, they're half-baked, as we like to say. They require additional approvals, they require additional construction, and sometimes just leasing up and putting tenants in place in order for them to become a marketable asset and so we can realize a successful exit. In general, all of our assets fit into 3 buckets. One is the planning stage, where we're trying to add value by moving the approval process along. 2 would be the construction stage, where we're utilizing either internal resources or external partnerships in order to complete houses, condos, buildings, etc. Or 3, revenue generating assets, where we have apartments that are leased up to some degree, or we have other operations to which are producing positive cash flows in many cases. However, we're holding until wait till the market is stronger in order to divest for these assets. Lastly, as you'll note, in the last 12 months, we've exited successfully from 4 assets and continue to look for opportunities to exit from more. I'm going to go through, I guess, our large 5 assets, and in particular with some updates. Woodbine Mall, as many of you know, 51-acre shopping mall site on just east of the 427. We have 4 initiatives that ran through the past year that we're continuing to work through. One is that we took the asset to sale last year. We had 4 ultimate bidders on the asset, all of which were essentially lowball bids or complex joint venture structures, and ultimately none of those came to fruition. Some of the challenges on this site, the one in particular, was the Hudson Bay lease, which, as many of you may or may not know, had a very long term, I believe it was 85 years, which was challenging for a buyer to have to deal with. As of this morning, the update is that our Hudson Bay lease has been officially disclaimed and therefore removed one of the largest impediments to the development and sale of the site. Additionally, in parallel, we've been working through planning process. We've engaged an external planning firm to move forward with development approvals to help maximize the opportunity for developers to come in and ultimately maximize a potential exit. The Mandarin Oriental Hotel in Boca. So this was a loan that was to the second phase of a master plan 3-phase project for the construction of a 166-door Mandarin Oriental Hotel. The borrower ran into challenges during construction, and since the spring of 2024 has been operating in forbearance. We've been working closely with the borrower in exploring refinancing options for both phase 2 itself, as well as a potential broader refinance of all 3 phases of the project with larger capital providers. Additionally, we're supporting the borrower for potential other solutions, which will unlock some of the value with some of the other collateral that we actually have in support of our file. LE Condo. So LE Condo is a file that's actually one of the examples of what Pete was speaking to earlier, which was the RDG team getting involved earlier in providing a borrower who was having some challenges with respect to repaying us within the term of the loan. We've worked collaboratively with the borrower to help ensure that they got the approvals to get their residential units finalized and closed, which obviously significantly paid down our loan. In addition to that, we're working with them to review their plans and help complete the project with the intent to help mitigate any tail risk. There's still assets to realize value on. Wes alluded to some of them earlier with respect to the office, as well as there's retail component, commercial components, and parking assets. Austin, Texas. This file is a 109-acre office/industrial site. It's very well located in the city of Austin. Austin was a city that had been booming for quite a while. It has seen quite a bit of slowdown of late. The reality for this file today is we're still working through ongoing litigation. Once resolved, we'll have an opportunity to explore our exit options. And lastly, our Atmosphere project in Richmond, British Columbia. This project consists of over 1 million square feet, mixed-use development across 7 towers, located near the airport. This asset is still in CCAA process and being managed by the court monitor. However, as the process has progressed, we did bring the asset to the market last year. We had several qualified bidders put in offers. Most, if not all, of the offers contemplated a joint venture type structure, going to the theme of there's not a lot of liquidity in the market. Therefore, most people are not writing all cash offers today. In order to essentially maximize our value on this, we have chosen a joint venture partner, which is one of the largest and most well-heeled developers in Vancouver. And we're in the final stages of negotiating a joint venture structure with them, to which we would see them continue the development of the site, and we would exit through condo closings as well as the sale of the income producing assets at the end of the project. This transaction is structured will allow us to preserve more capital from our invested basis today versus anything that was offered from a cash perspective.
If anybody has any further questions, we'll be up here. We'll deal with them one-on-one. Thank you very much.